Hey guys, welcome to our show. This is the first episode of a show which we will probably call Best Bitcoin Data or something else. Just tune in until we figure that out. The plan for this show is to bring you the best Bitcoin analyses curated over the week and presented periodically by the best analysts that we know and we work with. So this is the first session, uh, and we're just going to introduce the show and perhaps present some of the interesting data points that are relevant right now, and take it from there. So I have the pleasure of presenting this show with planc. planc is one of the uh, very famous analysts on Twitter and perhaps other platforms. He has a wonderful eye to catch, important and interesting patterns and interesting data points and present them in a very easy way. I myself am a business professor. I mostly analyze data and do research, and also I'm the co-founder of 21st Capital, which is a Bitcoin custody platform. So together and with the help of the many other analysts in the Bitcoin space that we know and we work with on a daily basis, we aim to bring you the best of Bitcoin weekly. Plancy?
Yeah, appreciate the introduction, and yeah, super excited to be a part of it. I've been wanting to do something like this for a while, and yeah, just being somebody that's been in the space for quite some time, looking into Bitcoin, I'm a very passionate analyst and somebody who really enjoys collaborating with other analysts who, really love to dig in deep into the data and really try to find the signal, and just it's just a passion to seek out and collaborate and figure out, okay, what are there's so many different lenses you can look at Bitcoin through, be it on chain, TA, power law, derivatives, like there's all these different lenses is the way I look at it. And so, yeah, I like to curate and try to kind of find the best stuff out there. And that's kind of what we're looking to do here. So super excited to be a part of it, like I said. And yeah, we'll be presenting, like you said, weekly shows here. And every week, we're constantly we're both full-time in the space, and we're always looking to create new metrics. Like both of us have created metrics that are completely novel in the space, many different metrics, and we plan to continue to do so. So not only are we creating our own metrics, but we're also going to showcase the ones we've seen that we perceive as being, in our opinion, the best ones available. So that's kind of the goal of the show.
Yeah, and then one of the big problems in understanding what's going on in Bitcoin is that we have 300 different charts that we can look at, and a lot of them are saying the same things. A lot of them have overlaps. A lot of them are actually frankly not really helpful. There are metrics that simply are price derivatives, so once you look at them, there is no predictive value to tell you what's likely to happen. And there are many other metrics that are misused. So what's really lacking in this space is curation, like the ability to select the most important signals, and perhaps, as you said, even making our own indicators that combine all kinds of data that we can access to and distill it into a small number of helpful charts that can tell us what's going on in different dimensions of the market. Because Bitcoin market is, there's a spot and on-chain activity, there's price trends and channels and oscillators that you can look at, there are derivatives that you can analyze, there's all the things happening with the ETFs. And I think what we have put together, even before beginning this show, has been an amazing group. I mean, we're working with Fred Krueger, Stephen Perno, Giovanni, who's doing a lot of work on power law, and Sminson with, and yourself, and numerous other analysts that are constantly trying to sift through tons and tons of data to figure out which ones actually work, which ones are actually relevant, which ones worth your attention. So our goal is to bring that to you. And I guess, yeah, the simplest way to demonstrate our plan is best Bitcoin data handpicked weekly. And again, it's important to mention that this is just an introduction show. Hopefully, we'll bring in more and more guests and more hosts. And yeah.
Yeah, and I just wanted to, just piggyback on what you said there, and just to get that point across even more. It's there is a real need for this. I do think in the space, in my opinion, like having been in the analyst space for years, I've gone through pretty much all of the on-chain metrics, and for years I was going through all the on-chain. There's tons of stuff, right? You can go to various websites like Glassnode that provide a lot of great data, but you go through them, and if you don't know, like, okay, which ones have more weight, which ones are actually valid, like someone with your kind of a background, that has the academic background and the data analysis background, like, I mean, you can actually verify statistically. It's not an opinion thing. That's the other thing. People want to have their opinions, and yes, there is a level of that, but we can actually validate these things and determine like which ones are better models. Like, it doesn't, so we can throw out the ones that, like you said, are essentially derivatives of price, and we can say, okay, like this one actually has signal, there, and it's probabilities, right? Like, everything is probabilities. And that's the other thing people need to understand, that, both of our perspectives and the way we come at things is, there's nothing that's definitive, right? When you're working with statistics and when you're working with data analysis, it's all about probability. So any analyst is saying they know 100%, this is exactly what's going to happen this cycle, we're going to this number, and then we're going to go down. It's no, we can tell you based on, regressions and all sorts of different things that, okay, there's these types, these are the probabilities. So essentially that's it. Like, we're really looking to go through and simplify as much as we can. That's the other thing. I feel like a lot of people want to understand Bitcoin data analysis better, and there's all these analysts on X that are posting a million charts, but if you don't have a background in this and you haven't put in a lot of hours, you can't decipher signal from noise. You just don't know. So what we want to do is not only present the best data, but we want to simplify. We don't want to talk over people. We don't want to, we want to come to, like, we want to present in a way that everyone can come along on this journey and follow, because we're learning also. Like, we're constantly learning. So we're going to make mistakes, but we want to bring, you guys along to understand these some of it. Maybe it's advanced statistics, but we can present it in a way that there's no reason why everyone can't understand these concepts.
Yeah, and when you post a chart and an analysis, it's very important to also understand what the method you're trying to do exactly is capable of, and what it's not, and what are the caveats and where it can go wrong, and how much of confidence you can have in various analysis. And that's another thing we hope to bring to the table. And between the two of us and the broader group, we have many years of training and experience analyzing data, and sometimes, frankly, a lot of misleading pieces of information gain a ton of traction, because just the people posting them don't necessarily know the limitations of various methods. That's another thing we hope to discuss as well. But yeah, so I look forward to keeping this up and continually bringing important signal to people. And I can't be more excited to have you guys join and discuss and help do this, because this isn't anything that any single person can do. It's a constant search for the best pieces of information in the Bitcoin space. And especially you have shown you have a great eye for identifying the important trends. And just having you there gives me a lot of confidence that we can do a fantastic show moving forward. Thanks a lot. And do you have anything else before we dive into our first set of charts?
No, we can get going here. And yeah, we can get into some charts, and then yeah, just so people also understand, like we'll be revisiting these charts. So we're not just going to show them one time. We want to, because instead of showing hundreds and hundreds of charts, like we said, we're handpicking the ones that we really think are valuable and useful. So we're going to come back to them. We're going to kind of have a rotation. So we'll constantly be, like we said, adding, or potentially adding. We will be adding over time new ones, but it's going to be a handpicked group, and then we'll be revisiting ever so often, right? So you'll be able to, like, if you see a chart, you're like, oh wow, that's a really cool chart. They will be revisited over time, so you'll be able to kind of get updates on these charts, right? So
Perfect. Okay, so today we have two ideas to discuss. Both of them are handmade. Both of them are, in-house created indexes. One is a volatility-adjusted Bitcoin Power Law Index, and the other one is Quantile Regression that planc and I have been super, super excited about lately. And we'll explain what those are and what they mean. And that will be the only ideas we'll discuss today. Okay, so if you don't mind, I'll begin with a quick introduction to the volatility adjusted model, and then we go to the quantile one.
yeah, sounds great.
Okay, so I have our
And
slide.
this is one you created yourself, Sina. Like this is one that you actually this model didn't exist, so this is actually one you did create
Yeah,
yourself.
this one.
Yeah.
Yeah. So essentially, I found shortcomings in what we already have, and tried to adjust some of the models and indexes to give us a much more clear signal. But before actually diving into this, I want to talk about this chart. This is basically a power law model, the familiar power law model, plotted against Bitcoin price. And you can see this light, this white line. This is the power law average prediction, which in the last year it was above the price. Then after ETFs came along, the price really caught up with the power law line, and then actually went above it, and it actually became a little bit overbought. Then after in Q2, all the ETF excitement subsided and kind of slowed down, and since then we've actually been very slowly uh, moving down, and the market is essentially consolidating and getting ready. Actually, we had a super nice pump lately, and this is getting ready to explode. And the further the price falls behind the power law line, the more chance that it will catch up rapidly. And this gap is really what I'm very interested in, like the gap from the current price to the power law price. And the further we stay here, the power law line keeps going up and creates a bigger gap, and that just makes a bit better and better investment opportunity.
And that,
Now,
sorry, Sina, just one quick second. That just to explain to the audience, that white dotted line, or the white line there, like that line is it's what's called an OLS regression, right? So that line, could you want to explain like how that line is derived and what it's based on and what it actually means?
yeah, so basically this is the power law OLS regression model, which is derived by logarithmic transformation of price and time. And once you do that, you get this very, very interesting model of Bitcoin, which is called the power law model, because on a log chart, you will see that the price of Bitcoin is just growing on a beautiful line. And the reason for that is it's just a mathematical implication of the power law relationship between price and time. And the beauty of that is this is not an overfit line. It's not something that only works now. It has been working. The same model has been working for at least the last 8 years. Essentially, if you did the same model in 2016, the parameters that it would have predicted for today, would be so accurate within $10,000, $15,000 of difference. It would have predicted the price today. So this is one of the most sound and robust and well-tested models that we have for average value of Bitcoin. So this white line, which I made really messy.
Yeah, and the regression, like, so the R squared is actually increased, like it's improving over time. Like you said, it's held steady. This model's held steady for, like, the growth rate of that line is held steady for the last 8 years. But not only that, it's actually the R squared has been improving. So it's only over time, it seems to be only becoming a better lens to look at Bitcoin through. And it's kind of stood the test of time. Given the data we have, there's only so much data we have for Bitcoin, but given what we have so far, I mean, the power law, as far as all the models we've looked at, it's one that specifically for the last 8 years, like you said, has held up really solid and seems to be only becoming, statistically speaking, the R squared is improving over time. And the slope, the growth of the power law slope, it seems to be stabilizing, right? Because it will adjust as new data comes in every day. That line does adjust, but it's been very stable, the slope of the growth of that white line for the last 8 years. So it's not like overnight it's going to move up or down dramatically, because the more data comes in, the more it stabilizes, and it's hit a point where it's really has stabilized. Would you agree? I guess, would you agree with those points, or how would you phrase it?
Absolutely, and I think that's one of the most important ideas here. That the model that we are talking about actually is not uh, is not overfitting. And just to give the audience a little bit of idea of what overfitting is, it's when you have a model, can be a line or some curve or something, that fits the data wonderfully now, but because it's not capturing real dynamics of the data, and instead it's capturing noise and just something that happened by chance today, essentially it fits the data by chance right now. Because of that, it will not be a good predictor moving forward. And the problem with a lot of the analysis that you find on Twitter or other places is they're mostly overfit data analyses that, they look awesome because the analysts looked at 1,000 different ways of fitting the line on the data, and, well, they found one that predicts perfectly what's going on in the current data because it's been optimized to do so. And essentially the model is only good for the past data after that point, because it's optimized for that. And then for future data, not necessarily. I mean, essentially we don't know. But one of the most powerful features of a power law model is that it's stable. So over time, as new data comes in, of course, it changes a little bit, but the general idea, general trend, and general predictions have been astoundingly reliable and robust. And that tells us that the line is capturing, this white line, what this is capturing is a systematic part of Bitcoin's growth, irrespective of all the volatility and noise that can happen. This is capturing the main show, the main part of what's happening.
Yeah, so you were talking about the delta, right? You were talking essentially about the delta between price and the OLS regression, which is essentially the line that makes all the data points. When you take all the data points in the power law, that line represents the line that's essentially the best fit. So it's a regression, OLS regression. So there's a delta that exists, and we actually, like you said, went above it, but now we're below it. So did you want to, I guess, finish up on your thoughts about kind of the delta, or however whatever you were gonna
Exactly.
go into?
Yeah. So again, great point about the OLS model. This line is derived by modeling the average or expected value of Bitcoin at any point in time. Expected essentially means there was supposed to be a distribution of values, and the line is just modeling the average point on that distribution, right? So there's a probability that price is going to be higher, or the probability that price is going to be lower at any point in time, as you can see, lower here and higher here. Now, what I did was that I measured these deviations from the average and converted them into an index. That's what we call volatility-adjusted power law index. Okay. And basically, this gives us, or VPLI, this gives us a single number to adjust, to essentially gauge where we are on Bitcoin's trajectory. Whenever this white line is essentially the power law model that we talked about before, wherever the dots are around that white line, it means the price is exactly on the power law predicted price. Essentially, that's the average in that period of time. But as you know, when Bitcoin, in all of the past cycle, Bitcoin has gone significantly above the average in various cycles, as you can see. And in all of those cases, our VPLI index has moved above 80 and much closer to 100. And in all of the bottoms of the bear market, we have gotten really close to the number 20. A little bit less here, but here as well. And this index essentially tells us whether the market is really cool or warm or hot, depending on how far we are from the average. Right now, VPLI is at 43. And as you know, it goes from 0 to 100. 43 is below 50. 50 would have been the average. So we are still, even with that beautiful pump that we just saw earlier, even do you remember what this number was? Like 50?
We actually bottomed out. I think didn't we go down to 48? Or no,
48, yeah.
no. Looking at the chart that we did, no. Sorry, no. That would have been about 50. I'm not sure exactly. 52.
Perhaps below 50 was not the close of the day, but I remember seeing a number below it. So it maybe closed above, but very close to 50. Yeah. And then from there to 65 is a huge jump. And importantly, this only brought us from an almost freezing zone, blue zone, to a green yellow zone. So we are still cool. We are still below the average, and it's still a great time to take advantage of the opportunity. We're not even at the average that the power law predicts. Essentially, this model also can be thought of as a fair value measurement, right? So at this point, the fair value following the trend would have been actually 77. So we are essentially underpriced right now. So that's what this chart gives us. And hopefully we will keep updating this and posting more about it to give people an idea of where we are. So if you're wondering 65, is it too expensive? Absolutely not.
Yeah, it's a 43, and what you've done here. Do you want to speak to the fact that you've done like this volatility adjusted? You've done this adjustment of using volatility, which is the only. Yeah, you're the first person to do this. So I've never seen anyone do a volatility adjustment on the power law before, and when I first saw this, I was like, okay, wow, this is actually, because I've looked at a lot of oscillators with on-chain data and various metrics within Bitcoin over the years, and what you get is a decay usually at the peak. So it's very hard to find oscillators that are actually consistent at the tops, which makes it more useful, right? Because if with every cycle, if the oscillators are decaying, and when I say decay, what I mean by that is we're kind of downtrending on the tops. Some people might be aware of for example, the monthly RSI. I think it's the monthly RSI oscillator that Plan B will show sometimes on X. Now, okay, great. There's an oscillator there, but it goes 100 and then it kind of continually downtrends. So it kind of makes you be like, well, what do I do here? Do I draw a line at an angle and just say when I hit this line? So it's a little bit leaves the person kind of guessing like where we are when you have a consistent oscillator with the peaks. And what you've done is you've essentially normalized. When I say normalized, what I mean by that is you've been able to adjust, the power law model. You speak to it, basically using volatility to kind of get a more consistent oscillator. But yeah, you maybe want to elaborate on that. I'm not sure.
Yeah, absolutely. I think so. The problem with the first thing that comes to mind is if you have, this is actually a different chart, or I should say the same chart, just different range. I've extended it to the whole history of Bitcoin. This is a basic power law model. Okay. Now, the first thing that comes to mind is to measure the deviations, as I mentioned, and up and down from the line, and to create an index based on it. But the problem is, like in the early years, Bitcoin was much more volatile. And remember, this is our logarithmic scale. So just a little bit of higher extension actually means a lot more deviation from the line in percentage terms. So when Bitcoin was young, it would deviate a lot more from the average, and the top would be like massively higher than average. Now it got a lot less as time went by. You can see this is now smaller. This peak is now a lot smaller compared to if you measure this in percentage terms. These peaks, the same thing, much closer to the line. And then perhaps our next peak will be closer as well. Now, so this causes a problem because when you create an oscillator based on this deviation, you get something like this. In the first cycle, you go way above your let's say this is our average power law model. I'm just going to say this is our this is our average. First cycle goes way above and way below. Second cycle a little bit less. Third cycle a little bit less. And you never know like how high is the next cycle. Here. You can essentially you lose any ability to determine how close you are to the top or how close you are to the bottom. Now, something else that I realized is essentially I try to think what's going on in this cycle versus this cycle. What's the difference? And I realize it's basically Bitcoin, because it's younger as an asset class, the same amount of money, the same amount of adoption in percentage terms, again, has a larger impact on Bitcoin's price. And it causes it to fluctuate way, above or below the fair value that comes from the power law model. It's simply because the asset is young and volatile.
Do you think that is that? Would you bring that? Sorry to interrupt, but would you bring that to like the order books? Would you say the order books were thinner then, or would you say there was just like the asset itself being a lower market cap, essentially like yeah, like I guess how would you describe that?
I think, you pinpoint a very important point that the order books were thinner too. Like a weekend purchase by a whale would have had a significant price impact at that time when the liquidity was really low. But right now, massive buyers might be buying right now, but we don't see much of an effect on a day-to-day basis. So little purchases or sales of big hands would have had significant impact early on, not as much now. It's the order book impact, it's the liquidity impact, it's the idea that there was just not enough buyers and sellers. And then a new buyer would cause a massive swing, a new seller would cause a massive swing. So that got me to the idea that it's actually, if we can get a measure of volatility over time, we can fix this decay, right? Oh, horrible line over there. We can fix this decay if we correct for the higher volatility here versus in the rest of the cycle and in the third cycle, so on. So I corrected all these deviations from the line by a measure of volatility. And I guess we'll get into it later, but essentially it's derived from the volatility, a daily volatility of the price number. So I look at all the volatilities that happen on a day-to-day basis, and I create a model based on it, and I adjust the index by that. So then you see, instead of these wild swings, most of the swings go within the same range, right? And that makes a good usable index or oscillator that we can use. So yeah, that's the idea.
Yeah, awesome. No, that's it makes sense. And this is really the goal in a lot of ways, in my opinion, is to like we said already, like kind of handpick these oscillators and these metrics that after doing normalization methods using statistics that actually have a logical reason why we're doing them. That it's not just like like you said before, just randomly trying to find like a pattern that, like you said, is only going to hold one time, but it doesn't have a methodology or like there's no theory behind it. Whereas this is an actual thing where it's like, okay, the volatility is going down. You can measure this, you can quantify it, you can verify it statistically, and you can say yes. There's like no one can argue. Like it's not like someone can say, no, you're wrong, Sina. The volatility is not going down. It's like, no, it's a numerical fact that over time the volatility has continually gone down for Bitcoin. Now, could that change for some bizarre reason? It could, and if it does, then we'll adjust. Right? It's not like we're stuck in any dogmas. So we'll adjust with our purpose in a lot of ways is to let the data speak for itself and just try to create the best lens for people to understand the data. And like I said, handpick it. So to try and find the best tools out there. And these are all just tools, right? At the end of the day, these are very, and we want to present the best tools available. So, but yeah, this is a great one. This is one I really like. This is one that when I first saw it, like I said, I was like, okay, this is definitely one to put in the Rolodex, and then it's just a matter of finding other ones, kind of equivalent, and that's what I've been trying to do as well. So, but this is a good one. We'll continually update this, and thanks for kind of explaining, the methodology behind it. And like we can go into more detail in future shows, specifically how, like the math behind it and everything. But this is a good starting overview of this one, I think.
Perfect. Awesome. So let's move on to the second idea, which is the quantile regression channel. Another extremely interesting idea, extremely interesting way to look at Bitcoin's growth over time, which gives us a very natural regression-derived channel. So, and I think the first time I heard about it was when you were discussing it, and I actually didn't think too deeply about it. And a while later, as I was working on these indicators, I thought, okay, what if we use quantiles? And I'd almost forgotten that you and I had discussed about it. So then I just ran some numbers and realized that if you're trying to figure out a top and a bottom limit for Bitcoin over time, using quantiles might actually work well. So I did some charts and looked like this is doing a great job. And then what really got me excited was that it derives the tops and bottoms not from something like a technical analysis, but it uses all the data. So essentially, it's fine. It finds the lines at the top and bottom such that 99% or 1% of the data are on the other side of it. So it's a regression derived model, not just data connections. And all these lines are based on the totality of the data, and that's what excited me a lot. And I wish I had paid attention to your point earlier. So tell us how you thought of this and how you came up with this idea.
Yeah, and I think your point is very important, because when you look at this type of a channel, it appears that it would look very similar to a lot of these models you'll see on X, where people are connecting dots. And it's not that connecting dots is a bad thing. I mean, it has its value, it has its purpose, right? Looking for certain patterns and connecting lines. But this is using, like you said, the entire data set. So it's not like a lot of these models that are connecting lines. They're only using the absolute peaks and then just connecting those. But this is using the like you said, the totality, like the full data. It's using the whole set. So, but yes, quantile regressions. You're essentially taking all the entire data set, and you're saying, like you said, for example, if it's kind of connected to percentiles. You could speak more to like the specifics on how you would convey it. But if it's for example, if it's the 0.5 quantile, then that would mean that 50% of the data points are above and 50% of the data points are below. And so, yeah, it's a way of would you say it's connected to like it's very much connected to probabilities? Would you say like there's definitely a relationship there? So
Yeah, absolutely. So just I'll just add this. The previous chart we were looking at was an OLS regression that finds the, sorry if I'm going to butcher this one, that finds the average, right? But here we are talking about quantiles, right? Which adds a whole new layer of, interesting ideas here. And what planc has here is um, 0.01 quantile and 99.1 quantiles, like, so the extreme high and extreme low quantiles that can come from a regression like this. And again, in our head we have this probability in mind, right? So at any point in time you think Bitcoin is going to have somewhat of a distribution, and that distribution has an average, it has a median, and it has multiple quantiles. The top quantile is captured by this line, and the bottom quantile is captured by this line.
right, and that's saying that out of all the data points, like if we're using like 99.9th quantile, so that means only 0.01% of the data points have ever gone above that red line, and on the opposite end, you can say, because it's a probability thing, you can say yes, there's a probability we can go above the red line, but the probability is based on historical the data set, it's 0.0, it's like it's 0.01%. So there is a probability of going above it, but that's the probability based on the distribution and based on, you could go like deviations and sigmas from, based on the distribution. So it gives you this range, and it gives you kind of like a max and min, you could say. And again, this is always all percentages, so anything can happen, but you can quantify it, and you can say, okay, we have actually like a way of saying that there's a really solid statistical reason why there's a low probability that we go below the kind of the lower bound blue line and above the upper bound red line. And it's a very useful channel, and I feel like we'll continue to iterate on this and improve it and look for ways to improve it. But I think it's something that Sina and me have essentially been working on and kind of come to, in a lot of ways on our own, kind of come to some similar conclusions around this. And we'll create some shorter term versions of it where you can kind of like zoom in and see more so say for this cycle where we are. And then this one is more of a longer term one. I wanted to show out to 2030 because I like to promote long-term holding of Bitcoin. I just believe that trading Bitcoin on shorter time frames, unless you have some very advanced advanced models, not to say you can't beat the market if you really put in the work and you really have some advanced models, but you have definitely a higher probability of being successful if you just kind of hold longer term. And so anyways, you can see here it's quite interesting because this is actually hourly data. So this is not only is this using the entire data set, but I actually pulled this from Glassnode using hourly data. So there's actually 120,000 data points here. And so when you take all those data points, this goes back to July 17th, 2010 is actually the beginning. So this is when Bitcoin first started trading on Mt. Gox, even though people know like the Genesis block was in 2019. 2009. It didn't start trading until July 17th, 2010. So every single hour, we have a data point that whole time, 120,000 roughly data points, and based on the growth rate of those top quantile regression lines, it's showing 880 for 2030 is kind of like the upper bound. As of now, there will be slight adjustments to this. It'll be interesting to see how it evolves. But yeah, it's showing, roughly speaking, anywhere between 200 and like say 900K, which is by 2030. I mean, it's not that long. If you think about it, for people that have been in Bitcoin for a couple of years, like, that's not that far from now. And we got like a 200 to 900 range is what the data is saying. Like that's just what the data says, right? Like we're here to just deliver what the data says as best we can. So
Yeah, and then some people are like, this is bearish or bullish. That's the data, right? So there's nothing we can do about it. That's if so. Essentially, the way to understand this model is if Bitcoin continues to follow the same pattern that it has followed in the last 10 years or so, which has been really, really fast growth and adoption. If it continues to do that, um, it is very unlikely for it to be above that red line and very unlikely to go below that blue line. Okay, and if I said how reliable of an assumption it is, I think it's pretty reliable for now because Bitcoin has just done this forever, and the value of a regression like this is in the idea that it captures what Bitcoin has done over its entire history. And you can always assign a probability that everything changes tomorrow and something completely different happens. But in the face of all the big things that has happened to Bitcoin, obviously Mount Gox hack, I don't know, the massive layers of adoptions back to back, country level bans,
the mining ban in China, the FTX, we've
FT.
seen Luna crash. Because I think that's a really good point you're making, Sina, is like a common criticism of models, like in general with Bitcoin, is people will say, well, what if this happens tomorrow? What if that happens tomorrow? Well, those are called black swans, right? So by definition, they're unknown unknowns. So I'm sure there's a way to put those into models, and we can work on doing so. And you have a very strong background in data analysis to, I'm sure, figure out a way to include these kind of black swans as best we can. But we've already seen black swans, and these models have held. So it's an interesting thing that people will use black swans or unknown unknowns as a way of trying to rebut. What did you just do? That's interesting.
That's
Cool
a
thing
Mac
there.
feature.
Oh, that's cool. Yeah, no, it's just interesting how like I guess we also want to dispel some of these easily dispellable criticisms of analysis, because they're very commonly repeated. It's like parroted on X is these same kind of ideas of like, what about this? What if this happens? Like, so these models have held, like we've said, given the black swans that have happened. And the white swans, like it goes in both directions. So black swan is like an unknown good event, and a white swan would be an unknown positive event. And these have happened throughout the entire history of Bitcoin, but yet these models have held. So we'll see what tomorrow brings, but it's just it speaks quite a bit to this, the likelihood that we continue to see these happen. And again, if something just absolutely insane happens tomorrow, okay, the model might break. But then again, none of us will care, because we won't be worried about analyzing Bitcoin. It would have to be such a severe event that there'll be bigger issues in the world. So
Exactly. And look at this. This is COVID. This is the COVID crash, right? And it didn't go below the line. And you can see this is the
and this is
bottom
hourly data too,
part
so
of
it's not like it even wicked below the line, really. But sorry, continue.
exactly. So you could have made this line even before COVID by creating a quantile regression that finds the lowest points in the data. And it would have been a little bit different, maybe this way or this way, but it would have been very similar. I actually draw it too wide. It would have been a very similar line. And this could have given you a very nice guide about what's the worst black swan that can happen at this point. And COVID, which was one of the like strongest events, um, only took us back down to the bottom of the channel. And then you could have created a channel only using the data up to here. Sorry, all the way up to here. And then that channel would have actually helped you predict the bottom of the next cycle. So even though a lot of things happen, some of these actually could have been the black swan events, but the channel holds, and that tells us that this is actually capturing some fundamental things that are happening in Bitcoin market. There's just so far there are just so many people that are ready to sell, and there are diehard holders that will never sell. So the deviation has a limit from the average, and this is only capturing those limits. And like you said, there's no certainty, but there's a very high probability.
Yeah, that's a great thing to kind of continue to reiterate, is that everything is probabilities, but you can have a high level of confidence based on those probabilities. And like you said, there's only so many weak hands that can be shaken out, so to speak, right? There are limits to these how many people are willing to sell. There's enough crazy people that no matter what the event, a certain number of people are going to continue to hold. And I guess we're some of those people, because, like you said, that last low where we basically bounced off the line there, that was the FTX crash, or FTX collapse following the Luna collapse. So not only did we have a Luna collapse that brought us close to the line, but then it ended up being the ultimate capitulation. And a lot of when you come down to that line, a good way to look at it is the ultimate kind of final capitulation of the cycle, because that's really the event that takes us down to those low probabilities of being near that line. And it's usually from a massive capitulation where you have a huge amount of people that are just shaken out because of the fear in the market is so severe, and the news headlines are so dire that people are just like, I'm done. And that is ultimately always the best buying opportunities over the long term. So I personally bought during the COVID crash. That was I was fortunate enough to get in during that event, and I've held ever since. And that FTX collapse was just an event I kind of held through. But that model I did use kind of like an extreme bottom, so that's like the 0.01 quantile. But you could use like 1%, right? The bottom percentile. You could have it so like 1% of the data points go below the line, so it's not as low. There's different versions of it, but and yeah, with this one, we can go through this really quickly. It's very similar, but with this one, I just added in the green line, which should be the 50th percentile, or the 50th quantile. So that's like the median, I guess you would say. Would you define it as that? It's kind of like that would be kind of like the fair value. Is a good way to look at it.
Let me tell the audience one of the beauties in here. One of the challenges with Bitcoin is that if you define a distribution for its price, it's not going to be a normal distribution like deviation. It's actually very skewed. Bitcoin spends most of its time in a bear market and a short amount of time in the bull market. It's kind of like 3-to-1. You have 3 years of pain and 1 year of gain. And because of that, actually the proper distribution is something like this, or it's just skewed basically. So, and that's exactly what you can see on this chart. You see, most of the time we are at the median. The median is actually a lot closer to the bottom, right? But the top is much higher. So this tells me that actually, if I have a fair value model like this, Bitcoin will go significantly higher, but most of the probability will be kind of accumulated in the bottom. So and a model like this allows us to differentiate those, right? It allows us to clearly understand that 50% of the time Bitcoin is in this range, and this is where the 99th percentile gets us. This is where they almost, what is it, like is it first percentile, right?
I think it's 0.001. Like it's in the bottom, either 1% or 0.01%. I think it's actually the most extreme. I think it's the 0.01%. Yeah. So you could do it as 1%, which is another way to show it. But this is like these are the extremes on both ends. But I guess with the 50th, with the 50th quantile, that like you said, that green line, we're 50% of the time we're above, 50% of the time we're below it. There's a bigger gap above it because we spend less time above it, or it's more explosive. Or how would you define it? It's like we go parabolic. That's another thing. Is we go people say, okay, Bitcoin's exponential. I mean, I don't know what your opinion is on this, Sina, but it's kind of like okay, for very short time frames, Bitcoin can kind of go parabolic or exponential, but it's never sustainable. And we always end up crashing back down to kind of the power law support, right? And that's really also what that blue line is its power law support is another way to look at it. So you can see those explosive moves up where we kind of short term during the full bull markets, we go exponential, we go kind of parabolic, but then we get close to the red line. It's like, okay, this is not sustainable, and then we end up crashing back down and finding support and spending more time, I guess, in that bottom range. But yeah, anyways, I'll let you kind of keep going there.
So yeah, I mean, I would say if there wasn't too much crazy speculation going on in the market, perhaps this green line would have been the best model for the price trajectory. So the price is, let's say, doing this beautiful growth, but because this is happening and a million other people are trying to speculate on it, as soon as they realize that price is going up, a bunch of speculators come in, take leverage, and bring in a ton of short-term money with the idea of I buy and then I'll sell. So the price goes higher than what it should be. Then this actually brings more validation to the market, and more people actually join with the speculative goal. And then this happens to the price. This convinces everyone that we are going to get rich and the Lambos are coming. And then this happens to the price. It's kind of a parabolic, exponential growth, but it's not sustainable because this is what's implied by actual adoption. So the further you are actually, the more it's kind of like debt. You have to pay back this debt. This is an unsustainable increase, and somehow you'll come back down here. But emotionally speaking, once we come back down to the more reliable price, people are just dead and tired and depressed and as you said, they're like, I'm done. So actually it goes a little bit below it as well, but it's always hovering around the median with significant jumps above it, and it always comes back. So that's essentially the anatomy of all these price volatility. Everything else from here and here, it's all emotions and adrenaline, right? The main thing is happening in this bottom channel, which is the real adoption. The rest is crazy speculation and hot money.
Yeah, that's well said. And yeah, I mean, it just like you can see where we are right now. It's quite interesting because we're literally at that green line. Like we're right there. We went, like you said, just barely above it. This is a nice zoomed out perspective because we're seeing like this. I like these zoomed out charts because it's good to zoom in as well sometimes and look at the short term because people care about short term as well. But to be able to zoom out and really see, okay, like where are we relative to the last cycle, right? Because you can see in the last cycle, it was quite interesting how we kind of bottomed out in the bottom of the bear market in towards I think in 2019, the first time. Yeah, just going back to the previous cycle, we actually kind of bottomed out. We didn't quite get all the way to the lower bound. Then we kind of shot above the green line, right? We kind of exactly. We shot above it, and then we ended up ultimately still crashing down to the bottom range during the COVID crash. But you can see, like, if you look at it relative to the halvenings, like we're kind of at the exact same point, roughly speaking, because if you look at where we were, I guess it would have been like say Q4 of 2020, right? If you compare Q4 of 2020, if we kind of say there's like this cyclical 4 or 5 year kind of liquidity cycle, or however you guys went into that on the Bitcoin Brain Trust last episode, into kind of like liquidity and things. But there's like this, say, 4 or 5 year rough cycle, and sometimes these cycles coincide. But if you look at where we were in, say, Q4 of 2020 compared to where we are now, we're kind of around that green line, very very similar, right? If you, roughly speaking. So we're pretty much, and people saying like, okay, the top's in, or anyone saying that, it just, the patterns don't show that. It shows we're at a very healthy. We're very healthy. Like, yeah, we had a pretty good move up and we shot above the green line, but we've kind of went back below it, just like we did there kind of after COVID. We were kind of hovering around the green line, and you can see like there's still tons of room to the upside for this cycle. We still could. It doesn't mean we're going to get all the way to the red. Like, that's another thing that people need to understand, is it shows an upper bound based on probabilities and regressions and quantile, but it doesn't guarantee we're going to get to the red. But you can see in all previous cycles, we've gone way above the green. So there's a high probability we go quite a bit above the green and somewhere between the green and the red. It's hard to know for sure, but we're definitely looking like we have still lots of room to move up, right?
So Bitcoin essentially has spent most of this year around the median. So everything that happened after approval of the ETFs, the high and the low, uh, is nothing really crazy. It's all playing around the median, and actually the potential to the upside is significantly more. I don't exactly know what this is, where this is touching, but let's say if we take this point, it might
I think
be.
380 is roughly. I think it's about. I think the upper bounds is around 380 to 400 for this by the end of next year. That'd be like the if we actually got to the red, which we didn't last cycle. That's another thing. Like we didn't quite get up to the red last cycle. Um, I believe that at the end of 2022, if we would have achieved, say we would have got to the red Q4 of last cycle, say 2021, if we would have got to the red line, that would have been just shy of 100K. So we didn't quite, depending on when we reached it, right? Like if it also depends on the timing throughout the cycle. Like when are you actually getting to that line? The longer it
Mhm.
takes to get there, everyone's in a hurry, right? Everyone wants to get to the red line tomorrow, but they don't understand that the longer it takes to get there, the higher that line is. The more that the line's moving up, as the model progresses, the bottom and the top lines are
Yeah.
moving up. So you don't want to. We don't want to peak, say at the beginning of next year. We prefer to peak maybe at the end of next year, or maybe even a bit into 2026, right? We don't know for sure when we're going to peak, but we can try to model as best we can the probabilities of peaking at certain points. But really, the longer it takes, the better, just based on the model. And if we did achieve the red line, which we did reach, in the 2013 peak and the 2017 peak, if we get there, then it would be actually like I believe like between 350 and 400. Now, we didn't get there last cycle, so say we're not saying we're going to get there, but that would be the kind of like the upper limits, I guess, for this
Yeah.
cycle.
And by the beginning of 2026, so end of last year, the median actually will be at 100,000. So 100,000 would just be the base, the base condition. If we're not in a bear market, we expect to be with no bubble because of the bull markets. 100,000 is a fair game. Now, of course, again, at some point, either early, which I don't think so, as you said, perhaps a little bit later, we will begin getting those. What's going on? We will begin getting the bubbles. Now, as you said, we don't know exactly when, at least it's not coming from this chart. We can probably do other analysis to have a timing, some insight into the timing, but this can actually surprise people. It can go down, which will be an amazing thing for me, because this is going to make many short-term minded people push them out of the market and just leave more opportunity for us, and then actually begin the real move up. Or it can spend a lot of time around this median thing and then go up at some point and crash at some point and go up again. But a channel like this just gives us a compass to have a really good gauge in terms of valuation, right? So at this point, I think, again, we should probably like mark these very well later. But uh, the
Yeah,
fact that we are right around the median, gives me a ton of confidence that we are not really in a bubble right now. And this price is exactly what's expected for this time of the cycle.
yeah, exactly. Yeah, and we'll be improving upon these charts and laying them out and having a way that people can even access these potentially live in real time. So we're going to be not only coming back to these charts and improving upon the way they're laid out, and so it's easy to kind of see exactly where we are. They're like we said, we want to provide the best tools. We want to provide these different lenses, these different maps to essentially analyze Bitcoin and be able to just join us. And we'll be sharing our insights as well and our opinions, but everyone can also come to their own conclusions when they have this data to look at. So yeah, anything
Perfect.
else you want
So
to add?
just to complement what you said, we're going to keep this going because I would personally love to hear more and more from analysts like you and other guests we will invite, and we will just keep tracking and following the interesting data points. This is a lot of price chart analysis, but we will also look at things like anything that impacts Bitcoin. Essentially, any data point. It doesn't have to be any power law necessarily models. Like I said, there's a lot of cool things from derivatives. You were talking about the buying at the bottom of the COVID crash. You could actually also gain insight into us being close to bottoming if you did look at the derivatives market at that point. So that's a lot of cool things we can discuss there. There is a slew of a ton of on-chain charts that we will discuss. So just tune in, subscribe, like, do all the good things, comment, share your thoughts with us. And our plan is to keep this going, and hopefully over time transition to a platform where you can see the charts live. The more support and interest you show, the faster we can get there. So we definitely like to hear more and more from you and see what's really exciting and attractive for you as well, to guide us as we build a whole data analysis powerhouse here.
Yeah, exactly. And yeah, if there's a specific thing that you're looking for or you think would be valuable for you, then just say, hey, what about this? Or I'd like to see this. So we're definitely open to it. We're kind of over time going to continually iterate and just get feedback and look to create a platform and just fill a gap in what people are kind of what's out there. I mean, I just, like I said, there's sites that have 100 different metrics, but people don't know which ones to weight and value the most. So that's what we're going to do. There's going to be a select group, and each one of them is going to be there's a reason why it's been selected. It's not random. These are really the cream of the crop is the way I want to look at it. I'd rather have less that are. You also, there's this thing with data analysis where you can basically pollute your data set. Like, so you actually need to be very careful because you can have, say, 5 or 6 metrics you're following, but it's about confluence too, right? You don't want to be over dependent on one idea or one metric or one lens, but at the same time, you don't want to add too many because that creates too much noise, and then you're ultimately capturing the noise. You're not capturing the signal. Like if you have, people, say you have 20 different charts or 50 different charts, like at a certain point, it's going to become too confusing, or it's like you see, and the thing is, like, Sina has, and the reason I'll just quickly share and then we'll wrap it up here. But the reason why I personally actually have sought out to work with Sina here is because I've overseen for years. I've kind of kept my eye out. I've been very involved in the space full time, and I've observed different analysts in the space, and Sina stood out in a big way to me as an analyst, who's someone who doesn't have the same level of background he has. And so, I have a lot of passion, and I really do, get a lot of feedback from analysts, and I'm constantly learning. But it really does, for me, it was really important to partner with somebody who has the actual academic background to verify, because I have a lot of ideas and a lot of theories and a lot of, like I said, passion, but I want to make sure that we can verify these ideas and make sure that they have strong academic backing. So that's really the collaboration here. So I'm excited about it.
Thank you very much for the kind words, and thanks a lot for doing this. I think it's something that it's really helpful for people to have access to, and it's a helpful tool to have, because like I said, all of us experience this data overload problem, and it's very important to have a reliable way to, just focus on the most important ones, not all of them. So thanks a lot for your analysis today. Amazing work. I look forward to just posting more and more updates on the Quantile channel, on the VPLI index, and all the other things that we will add, and just keep the audience up to date about what's going on and what's happening to Bitcoin.
Awesome. Thanks, guys, for tuning in. And yeah, look forward to more shows. And it's exciting. Yeah, thanks again, Sina, for taking the time. And yeah, we'll keep it going.
Perfect. Okay, so I'll see you next week.